If you've started saving for retirement, congratulations, guys, you are on the right path. However, how would you know if your 401k or IRAs are mismanaged, if they're misrepresented, if they're miscalculated, really spoiling that nest egg? This is the video that we're going to cover today, guys. The 5 biggest mistakes that we see with investments and retirement planning. Number 1 being not having a goal in mind. So for a majority of us, it is just saving as much as you can. But like running a 5K marathon, you really have to have a goal in mind of what your target is and exactly how much you do need to survive in retirement, how much you're looking for on a monthly basis and annual basis. This is going to make a huge difference depending on your age. Now, if you're 25 and you're just starting this, great. You have a long time till you retire. If you're 40, if you're 50s, if you're into your 60s, you have a very short timeline when that retirement could be coming upon you. Now, normally within retirement, you use about the 4% withdrawal rule, which means you can take 4% of your numbers. I'm a big fan of Dave Ramsey and how he says, do not touch the goose, guys. If you can get your retirement savings or your retirement plan up to the point where you can live comfortably on just the return that you're getting in there without having to touch the principal balance, that is really the way that you want to do this, guys, and the point that you want to get to. Managed portfolios, even with retirement plans, regardless of the company, can pay high fees. Now, this is something you really have to pay attention to what it is invested in. Over the long run, high fees can draw down the entire return of your portfolio, worse than we've seen before, especially if an index is down, if the stock market is down like we've seen in 2022. Couple that not only being negative in the stock market or having a significant decline, but now you couple monthly fees on that. Now you couple 1% fees. Overall, guys, this is going to eat into an incredible chunk of the portfolio. Just like we always talk about the compounding interest factor, where the more money you have, the more that it builds, the more that it grows on itself. Compounding factor can be game changing, eighth wonder of the world, but it can be the exact same thing when it comes to fees, guys. If you're paying a 1% fee on an entire managed portfolio, you could lose roughly $250,000 over 35 years if you're putting away $9,000 annually. That is right, guys. It is kind of crazy to think of how much that could cost. The third one that we get into is being properly allocated into the market. Now, investment should really reflect your age and your risk tolerance, where people in their 20s and 30s will have a very aggressive portfolio, which is the way that they want it. People that are getting closer to retirement age can go into more of a conservative portfolio. Now, what can happen is if you're getting for retirement and there's a sudden market crash, a sudden market downturn, this could affect the timing of you being able to retire. So what that means is, let's say you're 62, 63, 64, you're looking at retirement, then last year happens where you see a 22, 25% downturn in the market. That is a huge indicator of either one, a lot of people are going to sell off some of the assets because they're going to lock in those losses. It is really going to set you back for retirement. But number 2, guys, it could really throw off your retirement depending what you have it into, which is the reason why you have to sit down with your investment advisor if you're utilizing one, or if you're doing the self-investment strategy. Make sure you're looking at it at least at a very bare minimum, guys, at least once a year. That way you can keep everything on track and know exactly what is going on. Now, number 4 we get into is withdrawing too much. This is very similar, guys. When a lot of people get into that age of 65, which is the general age that Americans do retire, some people take around 4% a year. This should be enough if you're sticking to that 4% a year to make it through retirement with a very, very easy sale, depending on exactly how much you do have invested. Now, with that being said, a lot of people will take 5%, 7%, 8%. Not only are you withdrawing too much out of retirement, out of those accounts, you are also reducing the amount of time that you're going to be able to draw. For instance, if you're planning from, let's say, 65 to 90 is going to be the draw period at your 4% every single year. When you factor in a little bit of the growth factor, the 4% doesn't have a huge impact. When you start getting into, again, the 7, 8, 10%, this is going to go out and you are going to run out of money very, very fast, guys, because not only are you drawing more than you kind of expected during retirement, but coupled with that is you're going to lose all of the compounding interest that you're building, because again, every single time that they're doing calculations for the compounding interest, you're going to have less of a portfolio and less of a balance in there, meaning you're going to have a minimized or less of a compounding effect in there. And the final one, guys, that we see is taking money out for retirement. People a lot of times cash in the 401ks when they leave their job. They take the IRA money out early, whether it is to buy a house, whether it is to pay off debt, student loans, things of that nature. The retirement account is earmarked for one thing only, guys, and one very, very specific thing that is earmarked for. It is retirement. this is a retirement account. Now, it can be super tempting when it comes to, receiving a huge windfall of money. We see a lot of individuals that will retire from a career. 40 years they've been building up this 401k. In the first several years, the 401k is now at zero. That is right. They cashed it out. They paid their taxes, which of course, paying fees and taxes on that will absolutely crush a retirement savings plan, guys. When you look at how much money you're taking out, again, when you're talking tens of thousands or hundreds of thousands of dollars that you're moving out of the retirement accounts in a very fast manner, the taxes could eat up a ton of it. Again, really putting in jeopardy the longevity of having those retirement accounts for many years. So guys, that'll do it for today's video. Let me know in the comments what you guys think. There are, again, a couple big mistakes, guys, that you have to avoid with the retirement and also with the retirement savings. If you are leaving a job, make sure that you're keeping those retirement savings intact, moving it, rolling it over, investing it in the market. This is going to really ensure that your retirement and your retirement planning will stay on track. So again, guys, that'll do it for today's video. Let me know in the comments what you guys think. And as always, thank you guys for watching.